Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CRONOS Group INC quarterly report. CRONOS Group Inc. provides a diverse range of businesses and services, including cultivation, production, distribution, marketing of cannabis products brand offerings, plus spinach, plus Lord Jones, plus Peace Naturals product types, plus dried flowers, plus pre-rolls, plus oils, plus vaporizers, plus edibles, plus cannabis tinctures. The CRONOS Group Inc. (CRON) stock price has experienced significant increases over the past year due to a combination of positive financial results, strategic initiatives, and broader market sentiment within the cannabis industry. Key factors contributing to these surges include a profitable CON 2025 earnings report with EPS of $0.02 and a 28% year-over-year revenue increase. Strong Q2 2025 financial results, exceeding analyst forecasts, driven by international sales growth. Potential reclassification of marijuana in the U.S., sparking a surge in cannabis stocks. Reaching 52-week highs, reflecting growing investor confidence and the company's upward trajectory. These factors have collectively contributed to a notable increase in CRONOS Group Inc. stock price over the past year. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, strong demand in key markets for cannabis products has been a significant contributor. The completion of CRONOS GrowCo expansion and higher sales of cannabis flower and extracts in certain countries have also contributed to revenue growth. However, there are also drivers that have led to revenue decline. Decreased revenue from CBD products due to increased competition is one such factor. Additionally, lower cannabis flower sales in Canada and higher costs of sales and inventory write-downs have also contributed to the decline in revenue. Net income and profit margins. A shift in performance. The financial performance of the company has undergone significant changes over the past year. In terms of net income, the third quarter of 2025 saw a substantial increase to $28.32 million, up from $7.32 million in the same period in 2024. However, the 9 months ended September 30, 2025, experienced a decline in net income to -$2.4 million, down from -$3.9 million in 2024. Profit margins have also shown improvement. The gross profit margin for Q3 2025 reached 50.6%, a significant increase from 10.5% in the same period of 2024. This upward trend is consistent across the 9 months ended September 30, 2025, with a gross profit margin of 46%. In contrast, the operating profit margin saw a decline to -1.4% in Q3 2025, down from -72.2% in 2024. The improvement in gross profit margins suggests that the company has made significant strides in optimizing its operations and increasing revenue. However, the decline in operating profit margins indicates ongoing challenges in managing costs and expenses. Overall, these changes reflect a shift towards improved financial performance, but also highlight areas where further improvement is needed. The company's financial performance indicates a consistent trend of generating positive operating cash flow. The data from page 69 shows that in both 2025 and 2024, the net cash provided by operating activities was substantial, with $14,031,000 in 2025 and $11,123,000 in 2024. This demonstrates the company's ability to generate sufficient cash from its core operations, indicating a strong financial position. The company's debt level and interest expenses have undergone significant changes over the past few years. Regarding debt levels, there has been a notable increase in the non-current portion of loans receivable from $15,526,000 to $22,409,000 on page 4. However, subsequent pages, 11, 16, and 46, indicate no significant change in debt levels. This inconsistency suggests that while there was an initial increase, it may not have been sustained. Interest expenses have also fluctuated significantly. On page 65, interest expenses for 2025 were $517 million, a substantial decrease from previous years. However, on page 66, the 9 months ended September 30, 2025, show a net interest expense of -$2,438, which is lower than the -$3,919 in 2024. This indicates that while there was an initial increase in interest expenses, it has since decreased. Overall, the company's debt level and interest expenses have undergone significant changes over the past few years, with both increases and decreases observed across different periods. Regional Performance Overview. The financial summary reveals a mixed bag of results across different regions. Canada stands out as the underperformer, with net revenue declining in both 3-month and 9-month periods. In contrast, Israel has shown significant growth in net revenue during the same time frames. Meanwhile, other countries' performance is inconsistent, with some experiencing a decline in net revenue at the 3-month mark, but rebounding to show an increase by the 9-month period. Notably, Israel's strong showing was accompanied by an increase in property, plant, and equipment, while Canada saw a notable rise in this metric, despite its overall poor performance. Overall, these regional results highlight areas of strength and weakness within the company's operations. Management is cautiously optimistic about the company's outlook despite ongoing challenges. Key strategies include expanding into international markets, particularly Germany and the U.S., leveraging partnerships for cost savings, and continuing to distribute products in established overseas markets. The company plans to fuel growth through a new purpose-built facility and additional supply from CRONOS GROUP INC expansion by 2026. The company has made several strategic acquisitions and divestitures in recent years. Key acquisitions include Vitura, High Tide Warrant, High Tide Loan, Canisol Collaboration Loan, CRONOS GROUP INC, 50% ownership, and Altria Investment. Notably, the acquisition of CRONOS GROUP INC marked a significant milestone with 50% ownership acquired on July 1, 2024. On the divestiture side, the company has exited its U.S. hemp-derived cannabinoid product operations and plans to sell its Winnipeg, Manitoba facility, CRONOS Fermentation Facility. These moves reflect the company's efforts to optimize its portfolio and focus on key areas of growth. The company has made significant investments in its shareholders through share buybacks, with an authorized amount of $50 million and a total of 2,792,813 shares repurchased as of September 30, 2025. It is evident that the company has prioritized returning value to its investors by buying back shares rather than paying dividends. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. Inventory levels have been inconsistent, with a net decrease of $20,187 from 2024 to 2025, but also an increase of $15,018 between December 31, 2024 and September 30, 2025. Additionally, inventory write-downs increased by $194 for the 3 months ended September 30, 2025. Supply chain disruptions are also a concern, particularly due to the ongoing impact of public investigations into Canadian licensed producers and alleged dumping of medical cannabis imports from Canada into Israel. This has resulted in difficulty accessing raw materials on a timely and cost-effective basis. Furthermore, military conflicts between Russia and Ukraine have disrupted operations and those of suppliers and distribution channels. These concerns highlight potential issues with inventory management and supply chain reliability, which may impact the company's overall performance and profitability. That concludes the financial summary for CRONOS Group Inc. Feel free to comment below, and I will be happy to answer them when possible.